The Peter Schiff Show. We now return to the Peter Schiff Show. Call in now, 855-4-SCHIFF. That's 855-472-4433. Rebel Radio, the Peter Schiff Show.
This is Peter Schiff here at SchiffRadio.com. Joining the program now is Reggie Middleton. Reggie is a financial forecaster. He's also the publisher of Boom Bust blog. That's just Boom Bust, all one word, blog. He's got a BBA in business management from Howard University in Washington, D.C., and his website has focused on the housing bubble, on what's going on in the stock market with the financials. Anyway, welcome to the show, Reggie. Hello?
Yeah. Well, thank you.
Reggie.
Yes.
Are you there?
Yes,
I can. Well, thanks for coming on the show. So, obviously, you know, the big IPO that Wall Street is getting everybody, psyched up for is Facebook. And Facebook is going to come out sporting a valuation of something like, 500 or what is it? What is it? A $100 billion valuation on Facebook, or two? I forget what they're contemplating this IPO at.
Yeah, I'd like to call it a price and not valuation. There's a difference. Valuation implies that there's an actual value attached to it.
Well, the price does assess a value to the shares, because people are going to be buying the shares. So the price is supposed to reflect the underlying value of the company, at least according to the bankers who are asking their clients to buy shares. Correct?
Correct, and that's the point exactly. It's my contention that Facebook is an interesting opportunity. Definitely a very strong marketing story. But the numbers that are being bandied about are simply outrageous. It's the .com boom times 2 all over again. Best case,
and you can see that.
Yeah,
it's not just in Facebook. You can see that in a lot of other social media type stocks that have come public, let's say in the last 6 months. And most of these IPOs are doing horribly if you look at the current share price for stocks like Zynga or Pandora or Groupon, and you compare them to where they were when Wall Street brought them public. These stocks are down dramatically, but no one even knows if they're anywhere near the bottom, because a lot of these companies, they're still not making any money.
Exactly. And it looks as if Facebook may be coming public at about the time where you're going to have a macro breakdown stemming from the European markets. If that's the case, then, being overpriced and a fundamental overvaluation, it would just be a piece of the puzzle that goes in. The investment banks are doing their job, and their job is to sell, not necessarily to enrich their clients, unfortunately.
Right. Remember, the sellers are also their clients. So, you wear two hats when you're on Wall Street, right? If you're doing an IPO, you have two clients. You have the company whose shares you're selling, and the company is paying you to unload their shares. And then you have the buyers who you're trying to encourage to buy the very shares that you were paid to help sell. So you represent both sides, which is kind of weird. When you in real estate, usually there's a seller's agent and then there's a buyer's agent. But in many cases on Wall Street, the investment banker wears both hats simultaneously. The question is, where are his real loyalties?
Somewhere along the bonus pool, if I had to make an assumption.
Yeah, and of course, if you do enough IPOs and you screw enough of your clients who buy the IPOs, eventually, theoretically, you won't be able to do anymore because you'll run out of clients. Your clients will no longer feel you're credible. So there are some, market forces that would try to cause Wall Street to strike a balance between the interest of both the seller and the buyer. But, sometimes the buyers in a mania are willing to pay crazy prices, And I think that's where Wall Street really drops the ball. They did it in the dot-com bubble, and I think they're doing it now with these stocks, is they're not trying to temper that enthusiasm. They're not trying to bring their clients down to earth by discouraging them from overpaying. They're kind of, beating the drum, fanning the flame, and trying to get everybody all excited so that they overpay.
Right. Well, if they were to bring a sense of normalcy or realism to the IPO process, that would be the antithesis of their profit model. Remember, the larger the IPO, the larger the gross proceeds, the larger their takedown. So,
plus also
incentive.
Plus, also, a lot of the deals come with warrants. So the underwriters get warrants to buy shares of stock in the company they're underwriting. And if the stock price goes way above the strike price, they can exercise those warrants and make a huge windfall. So they have some incentive to jack this price up, at least in the short run, so they can cash out those warrants.
Of course. I mean, if I were to play regulator, there's a relatively simple way to cure that problem. And you make the warrants long term. So you stagger it 1, 2, 3, 4, and 5 years. Hence, now there has to be some permanency in the underwriting model in order for the bank to profit.